All right, let's talk about 2024. This was the year a brand new financial product hit the scene. And honestly, it was a total game changer, bridging the wild world of crypto with old school Wall Street. We're talking, of course, about crypto ETFs. So in the next few minutes, we're going to break down exactly what these things are, how they work, and what their arrival really means for you as an investor. So, what was the big deal with 2024? I mean, for years, right? If you wanted to invest in crypto, you had to figure out new apps and digital wallets. And the whole thing was kind of complicated. Well, this was the year all of that changed. It was the moment digital money finally walked onto the main stage of finance, where you could get in on it using the same accounts you use for regular stocks. And this whole shift was kicked off by a few landmark decisions from regulators. It all started back in January when U.S. regulators finally gave the green light to the first ever spot price Bitcoin ETFs. The industry had been pushing for this for years. That one decision just opened the floodgates. Suddenly, 11 new funds hit the market, and boom, it kicked off a massive bull run. And it didn't stop there. By July, the SEC did it again, this time approving ETFs for Ethereum. Okay, let's get into how these things actually work. To really get why this is such a big deal, we need to do a quick refresh on what an ETF is in the first place, even before we get to the crypto part of it. You know, at its core, an exchange-traded fund, or ETF, is actually pretty simple. The best way to think about it is like a shopping basket. A fund manager goes out and fills that basket with a whole bunch of different assets. Could be stocks, bonds, or in this case, crypto. Then, you, the investor, can buy a single share that represents that entire basket. And you can trade that share on a stock exchange, just like you would for a single stock. Now, this is a really important point. Not all crypto ETFs are the same. The huge breakthrough in 2024 was the approval of these spot price ETFs. These are the funds that directly own the cryptocurrency. So when you buy a share, you're buying a tiny piece of actual Bitcoin that's held by the fund. This is way different from the futures ETFs that had been around for a while. Those don't hold any crypto at all. They just track the price of contracts that are basically betting on where the price is going to go in the future. And listen, the launch of these things was not some niche event for crypto enthusiasts. Just look at the names on this list. We are talking about the absolute titans of the financial world. BlackRock, Fidelity, ARK Invest. When institutions this big jump into a market, you know it's a major shift. Okay, so why all the hype? What is it about wrapping crypto in an ETF that got so many investors interested all of a sudden? The appeal really just boils down to two simple things: convenience and familiarity. For the very first time, people could get exposure to Bitcoin through the exact same brokerage account they use for everything else. No more special crypto wallets or signing up for new platforms. Plus, these things are super easy to buy and sell on major stock exchanges, and they come with all the usual investor protections and oversight you'd expect from a regulated product. But, and this is a really big but, while the access to crypto has become more traditional, the asset itself has not changed one bit. And it is absolutely crucial to understand the very real risks that come along with any crypto investment. The first and most important word you have to know is right there on the screen: volatility. The prices of digital assets are legendary for their extreme, wild, and often totally unpredictable swings. This is, without a doubt, the single biggest risk factor. And putting it in an ETF doesn't change that. And let's be crystal clear about this. Putting crypto into an ETF wrapper does not get rid of the risks. You are still completely exposed to that insane price volatility. The rules and regulations are still up in the air. And unlike a stock, which is tied to a company's actual performance, a cryptocurrency's value is, well, it's a lot more speculative. An ETF doesn't change any of that, and it for sure does not protect you from the potential for big losses. So, after weighing the convenience against all that caution, what's the bottom line? What are the essential things you really need to remember here? This really brings us to the core question you're probably asking yourself right now. Does all of this mean that investing in crypto is finally a safer bet? And the answer to that is a very clear and simple no. This is probably the single most important takeaway from all of this. These ETFs offer simpler access, they do not offer reduced risk. The underlying volatility of Bitcoin or Ethereum is exactly the same whether you own it in a digital wallet or as a share in an ETF. Which leaves us with maybe the most timeless piece of financial advice there is. Look, these products are a huge milestone, for sure, but they don't change the basic rules of smart investing. The advice is exactly the same as it's always been. You have to do your own research and really truly consider the risks before you even think about investing any of your hard-earned cash. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.